Hi, thanks for watching. In this video, I'm going to continue highlighting main points from the book, Options as a Strategic Investment by Lawrence G. McMillian. We're on part 2 titled Call Option Strategies. This video is on chapter 2, which is all about covered call writing. With that said, let's get into it. If you're not familiar with covered call writing, it's a strategy that involves selling a call option while simultaneously owning typically 100 shares of the underlying stock. Covered calls are great for decreasing downside risk while increasing profits during stock ownership. Covered call writing is best used when you're bullish or at least neutral on the underlying stock. Let's look at how covered call writing works using an example from the textbook. A trader buys 100 shares of XYZ with an average of $48 a share. Then, using those 100 shares as collateral, the trader sells a July $50 call option for $3 a contract. This results in a total of $300 in premium received. Let's break down how this trade could perform under a few different scenarios. Scenario 1, the stock price rises to $50. When the underlying stock increases slightly, in this case, if XYZ is 50 or less at expiration, the trader has the best of both worlds. She gets to keep the full $300 of premium initially received when she sold the call, and she gets to keep her stock, which has also risen up to $2 a share. Scenario number 2, XYZ drops in price. The trader got $300 or 3 points in downside protection if XYZ were to fall in price. XYZ could drop up to 6.25% and the trader would still break even on this trade at expiration. If XYZ drops more than $3, that is lower than $45 a share, one side of risk on this trade materializes since the stock fell more than the premium received. Scenario number 3, if the stock price rises above $50. If XYZ rises above $50, the trader has a choice to make. First choice is to do nothing, let the call option expire to receive maximum profit potential. That is $200 from the rise in stock price and $300 in premium. The only downside with this is the trader loses her shares when they get called away at expiration. The other thing she can do is buy back the option she sold. This choice may result in a loss on the option part of the transaction, but she could profit more if the stock continues to rise. Remember, no matter how high a stock climbs in price, the profit from covered call writing is limited because the call writer is obligated to sell the stock at the striking price of the call. You can potentially outperform stock ownership alone if the stock rises, falls, or trades sideways. Consistent call writing can also help decrease position volatility during stock ownership versus owning the stock alone. If you don't want to lose your shares, do not write a call on them. Remember, there is always a risk of losing your shares. Of course, all covered writes involve selling a call against stock that is owned, but there are different terms to describe the categories of covered writing. The two broadest terms covered in this chapter are in-the-money covered writes and out-of-the-money covered writes. In other words, you can write an aggressive or defensive writing position. In the finance world, investments with lower risk also tend to have a lower reward. The call writing strategy is no exception. In general, out-of-the-money writes offer higher potential rewards, but less protection than in-the-money writes. This is because more of the profits come from the rise in stock price than the premium received. Since less premium was received, you have less downside protection. In-the-money writes offer more downside protection, therefore less risk, but they cap profit potential. More premium received offers more points for the stock to drop and still break even, but since the call was written in the money, you likely won't be able to profit much if the stock is over the strike price of the option at expiration. If you write an out-of-the-money option, you should probably be very bullish on the stock. If you're neutral or even slightly bearish, an in-the-money option is more appropriate. This chapter discusses the total return concept of covered writing. The total return concept of covered writing emphasizes downside protection and maximum profit potential as the most important factors. This type of writing involves being willing to have your shares called away. This strategy represents the idea that the writer views both the covered call and the stock as one position. With this strategy, a trader could lose money on the stock ownership side of the transaction, but make a profit overall with the premium from the call option sold. Let's look at a quick example from the book to see how this could work. A trader buys 100 shares of XYZ with an average of $45 a share. Then using the 100 shares of XYZ's collateral, the trader sells a July $40 call option for $8 a contract. This results in a total of $800 in premium received. At expiration, the following profit could result if the underlying stock is above $40 a share, minus $4,500 for the price of the stock, plus $4,000 for shares called away, plus $800 in premium. Total profit equals $300. When it comes to establishing covered right transactions, the book says you should calculate your expected return in 3 different scenarios. Scenario number 1, if the underlying stock remains unchanged. Scenario number 2, the return if exercised, or in other words, if the shares are called away. Scenario number 3, the percent of downside protection as it compares to volatility. The reason you want to compare the percent of downside protection to volatility is because 10% downside protection on a low volatile stock like McDonald's is actually more protection than on a volatile stock like Rivian. It's best to execute a covered right in the same transaction, but beginning trading apps like Robinhood don't allow this. If you use Robinhood, you run the risk of not getting your ideal fill. On Robinhood, you have to already own the stock in order to write a call against your shares. I still trade on Robinhood though, and I sell covered calls all the time. I'm just aware that my fill may be 5% or more from where I want it. Not all covered rights make sense mathematically. The book suggests a rule of at least 1% return rate per month if the stock didn't change in price. The projected return rate, if unchanged, can vary drastically if you look at contracts deeper in the money or out of the money. It also lists at least 10% in downside protection as an ideal benchmark to shoot for. However, due to volatility, 10% may not be enough for volatile stocks. If you have the ability to write multiple calls against your shares, you can diversify by writing against different strikes and expiration dates. Just like any trade, there is follow-up action and monitoring required once you write a call. Your trading plan needs to have the following: protective action to take if the underlying stock drops too far in price, aggressive action to take if the stock rises too fast, and action to take to avoid losing your shares if necessary. Protective action could involve closing your entire position or rolling down your strike to capture more premium. Aggressive action could involve rolling up your covered right in strike or to a further expiration date. Action to avoid assignment may be necessary if you decide after writing that you don't want to lose your shares. There's a variety of reasons you might want to keep your shares, but it could be because of newly released information or to capture a special dividend. Here's some important formulas you might want to keep on hand from this chapter. The formula for max profit on a buy right trade is as follows: strike price minus stock price plus call price. To calculate break-even point on a buy right is stock price minus call price. Well, that concludes Chapter 2 review. I hope I was able to recap the information in a manageable way. Feel free to check out my video on Chapter 1 if you're new to the channel. Take care and remember to trade gingerly.